Mics are here. 1, 2, 1. One, two. One, two, three. Mic testing. 1, 2, 3, 4, 1, 1, 2. 2, 1, 2, 3, 1, 2, 3, 4. Mic test 1, 2.
Hi, I'm Seema Gohil, the Director of DigiFarm, Safaricom's digital agriculture platform.
My name is Jared Uchin. I work for the financial sector deepening Kenya. Currently, I serve as the Senior Agriculture Specialist.
My name is Penina Wanja. I'm the founder and MD, DigiCow Africa Limited.
My name is Pius Sige. I'm the founder and the CEO of Amtech Technologies Limited.
Morning, ladies and gentlemen. Just preparing to start. I hope we can settle in. Anyone out there? Okay. Thanks for making the time to be in this session. This is the Financial Services breakout session. My name is Paul Kweheria, and I'm the Managing Director and Lead Consultant for QuadT, which is a project management firm in inclusive finance. And for today's session, we are discussing and having presentations from some distinguished presenters and speakers who will be with us in a few minutes. And what we'll be talking about is how we can find effective partnerships and making them work for smallholder farmers. And these are partnerships we are discussing around financial services for smallholder farmers. The objective of the session is to discuss how we can be able to draw up from success from partnerships, what are the challenges, and how we can be able to learn from some of the very interesting partnerships and examples that will be presented here. The first session will be led by Jared from FSD, and he'll be taking us through a partnership they have built on warehouse receipt financing and how their collaborative pilot has gone. Successful, what are the learnings, what are the challenges, and he'll have a few speakers to be with him in that session. After that, we'll have a panel session led by Jamie Anderson of CGAP that will be speaking to financial institutions on their partnerships for financial inclusion. So we have 3 banks or financial service providers in the market who will be there. We have NCBA, we have Equity Bank and Family Bank. So that will be an interesting conversation as well. Towards the end of the session, we'll have Rupsha from ILRI speaking about their innovative and risk financing solution that they are working on, specifically looking at keepers and farmers in the drylands. That will be an interesting one. So Rupsha will be taking us through that session towards the end. Now, you'll realize that we are an hour late from the initial session. Here it's stating we were to start at 10. We're about an hour late because the initial plenary took longer than expected. So what we are going to do, we were supposed to have 2.5 hours for this session. We'll try and squeeze it within 2 hours. So we are going to run through the various sessions, the 3 key sessions that I've spoken about. But what we want to do is really unpack how the competitive landscape can be supported through collaboration and how we can be able to learn from key success stories, some key challenges, looking at where we could be able to leverage in this whole space on making financial services work for smallholder farmers and small-scale producers. So it's my pleasure to invite Jared Ucheng from FSD to join us and take up the session from here. Yeah, so that's that, and then you'll introduce.
Thank you very much, Paul. I guess before I start, I'll welcome my team, the panelists, who also come to the front because we just want this to take as short time as possible. My name is Jared. I work for the financial sector deepening Kenya. Currently, I lead our agriculture finance work. And one of those things that we're trying to do, I guess my job is very simple. To give you a situational context to this solution that we're trying to work together with the Agricultural Finance Corporation, the Warehouse Receipt System Council, and of course with a lot of technical assistance from Genesis Analytics. And this is the landscape for the country. Having at least 7.5 million smallholder farmers, at least 90% of them having less than 5 acres. If you look at those schematics, then you're able to see how farmers have access to land. The annual produce, of course, disaggregated with females, by females and males. If you look at where women are mostly concentrated, their annual produce range between 1,000 and 3,000 kilograms. That is 1 to 3 tons. That is where they're largely based. If you look at men, of course, a majority of them are just therein. But if you compare the two sessions, then you realize that women are facing the brunt of it in terms of less than 1,000 kilograms in the acres that they work on. The fundamental issues that we were trying to address using this work focuses on 3 key areas. I mean, the first one is access to storage. Losses are about 50%, according to the IGAD report drafted in 2021. So we are experiencing harvest losses of up to 50%. And if you look at those that the storage facilities that farmers use, they are still on their own at 94%, private warehouses 9%, and public at 6%. But then if you look at the aspects of price discovery and price volatility, you realize that there is somewhat a dissatisfied level in terms of price discovery for the produce that they engage in. And lastly, if you look at finance, so to speak, right now we know that access to finance is not necessarily an issue because you look at Kenya, for instance, 8 out of 10 are able to access finance in comparison to 2006 when it was 3 people out of 10. So we've made some strides. But in terms of for the small holders, collateral is a huge issue. And you see there from the statistics again, inadequate collateral plays a key role in inhibiting smallholder farmers in access to finance. And this is why, as a consortia working together with the Warehouse Receipt System Council, the Agricultural Finance Corporation, guided by Genesis, we are thinking through one of the key tenets of the MTP4, the Warehouse Receipt Financing, to address some of the aforementioned issues. So without further ado, introducing John. John works for the Ag Finance Corporation. He's an economist there. Currently is the Chief Business Strategy Officer. Then there is Jacqueline Odundo. Jacqueline Odundo is the Head of Legal and Company Secretary for Warehouse Receipt System Council. And then there is Tito Gishuhi, who is the Manager for Financial Services at Genesis Analytics. So a quick question, just to level the playing field. Just to ask Jackie, what are warehouse receipts? And what is a warehouse receipt financing solution? Do you think there is value for smallholders in use of the warehouse receipts as a conduit for them to be able to even access some of these credit to continue in their work as farmers?
Oh yes, definitely, because the usual financing, commercial financing, they require the traditional funds such as title deeds, which majority of them, especially the women and the youth, don't have access to. So now they can use commodity by accessing quality licensed storage facilities to access this type of financing with the warehouse receipt as they look for clients or off-takers. And it's, with this warehouse receipt financing, they're also able to access affordable financing, which should be cheaper than the already available commercial financing.
Thank you, Jackie, for that. Just to double down on that, but to John, what channels working with smallholder farmers would be best to deliver this kind of a solution? Because largely smallholder farmers, as you see the way they are organized, I mean less than 5 acres per smallholder farmer. I mean there has to be a need for an aggregated model for it to work. I mean, what would you say to that respect?
Thank you. Just a quick brief about AFC. AFC is a financial institution, a DFI, wholly owned by the government, and focusing 100% on the agri-sector. We work with all the value chain actors, from producers up to the market exporters, and so on and so forth. We also have a special focus on the excluded, or the smallholder farmers, the women, the youth, and we have initiative that I'll talk later about to make sure that these groups are included. Coming to those groups, one of them is smallholder farmers, and their key issue is not lack of access to financial sources, is the aspect of collateral and collateral mechanisms. So you also look at their productivity. They don't have economies of scale as an individual unit, but it would be better if they are collective in a cooperative or such a organized group that would enable them not only access finance, but also access other services, including, input, sourcing of inputs, sourcing of other services, and even bargaining or having a voice in policy and other issues around their operations. So a collective model is the best way to go. And I'll give a short perspective of AFC. 3 years ago, through the assistance of AGRA and IFAD, we developed a wholesale lending model focusing on SACCOs that are in agri-sector. We have been able to triple our outreach to smallholder farmers. And the funny thing about that, or the most interesting thing, is that that model or that scheme has 0% arrears or default. Yeah? Yet we are reaching the smallest farmers, the smallest micro, medium, SMEs in agriculture, and it has worked. So for smallholder farmers, what do we need for them? I think the starting point should be aggregating them in common perspective groups, especially SACCOs, producer cooperatives, marketing cooperatives, and so on and so forth.
In that data that we was more or less the rationale for this discussion, there is a comparative disadvantage to women, especially so in access to some of these collateral, as you mentioned, because again, contextually women, socioculturally in Kenya, they are largely disadvantaged towards access to land. Would you probably also just want to talk about that a bit in the context of group-based model financing and how we can bring on board a lot of women into an active full-scale sector-wide access to finance, so to speak? What would be your views on that?
Thank you. Actually, that is a very critical aspect. If you look at the FSD Central Bank FinAccess Survey, the last one of 2021, you'd see that though the financial access has improved, in agri-sector, it is worse compared to other sectors. And in agri-sector, it is worse for women as compared to men. Going back to our perspective that AFC has an experience in, from that wholesale lending model, the outreach before, our portfolio was around 8% outreach to women. In the cooperative or wholesale lending model targeting cooperatives and SACCOs, the outreach to women is more than 50%. You can see the impact. Why? Women in agri production and agri MSMEs, they are more organized in groups. they have more membership, or they ascribe more to circles and groups, as opposed to doing it individually. So is it going to address the issue of exclusion? I think so, especially to women and youth.
I would have wanted to go into collateral management right now, but before I get there, you mentioned aspects of policy, and probably just to request Tito to address this. Are the policies, guiding this kind of an endeavor sufficient in your own view, and do you think that there is more to be done within that space?
Yeah, so there are some gaps, policy related. I would like to think of the kind of problem in two kind of distinct ways, one relating to reach and the other relating to confidence in the warehouse receipt system and warehouse receipt financing. Relating to reach, the infrastructure that is currently present in the country for warehousing solutions on the number of warehouses is quite inadequate and quite far from the smallholder farmer. One of the ways to address this, of course, is to encourage private warehouses to open up and operate. However, licensing of private warehouses is a key challenge, largely because licensing is done at a county level, and there isn't a harmonious or coordinated way of ensuring that the licensing requirements for private warehouses are the same across the counties. So a private warehouse operator would face different licensing requirements, different waiting times across different counties, which makes it much more harder to scale its operations across the country and therefore reach small scale producers easily. On confidence within the warehouse receipt system, I know that the Warehouse Receipt System Council is doing a lot of work on this, but one of the ways to boost confidence, especially amongst small-scale producers, is digitizing that ecosystem, enabling them to have a real-time view of kind of the management of the produce that they have deposited at different warehouses. A digital platform or a USSD platform that would enable them, just give them that confidence that I can go on my phone, use a USSD code, check that, hey, actually my produce is still at this warehouse operator and is safe, would really boost the confidence of small-scale producers to kind of get into warehousing and increase the adoption of this. On the other hand, for financial institutions, there's also an issue of confidence in the effectiveness of the deposited produce as collateral, as a credit risk mitigation measure. It's a new system in the financial sector, and therefore there are questions, there are a few doubts that commercial financial institutions will have about it. So policies such as, by the government to say share risk or to provide some credit guarantee mechanism could help alleviate those concerns and just boost confidence in the short term as financial institutions get experience working with warehouse receipt financing solutions.
How about, say, the regulatory space? Is it sufficient to handle this kind of an engagement within the country, in your own view?
I think, so there are a number of, say, international regulations that, would make some financial institutions a bit nervous about going into warehouse receipt financing. The adoption of IFRS 9 and Basel 3 that make it that are much more stringent on financial asset classification with respect to risk. But I think that can be that could be addressed by providing, for example, the credit risk guarantee or credit risk sharing mechanism.
Jackie, from Tito's point, he mentions collateral management as one of those issues that comes out in the course of this work. What could you elaborate on the status, of collateral management within the warehouse receipt system, as it is?
Okay. So the nature of collateral management in the system right now is we have the financial institutions are actually the ones that appoint collateral managers to manage the commodities in the warehouse receipt system. But the other issue is the cost, because there are very few qualified collateral managers in the country. I think about 5, the last I checked. And who then would, then that cost would be then passed on to the farmer, making it, not making it advantageous to them. So what we are trying to discuss in the ecosystem is whether now some of the warehouse operators would serve as collateral managers to be able to, not have an additional cost burden. So the existing warehouse operators like NCPB would be able to do that. And then for financial institutions, they could, if there are various, let's say about 2-3 financial institutions, and they feel like they want to appoint an independent collateral manager, then they can appoint one so that they can share the cost and not be able to pass that on unfairly to the farmer or the depositor, making the access to the finance more expensive. So that's what we're engaging in.
John, are we ready for a warehouse receipt financing solution? Is Kenya ready?
I could say yes and no. From commercial bank perspective, I think as Tito said, commercial banks are about, they are not quite, they're quite reluctant. But as a DFI, we must see what can work, what cannot work. For AFC, yes, we are ready. As you are aware, we have been supported by AGRA, by FSD. We have developed a product, a pilot, and a pilot framework. And you're just waiting for some few areas to be fine-tuned, and we are ready for a rollout. Actually, we were targeting to have it rolled out and document the lessons by this harvest season. In terms of what we need to do to make sure the commercial banks are ready, I think Jackie has addressed. We need to make sure that we address few things that are pending, because commercial banks in our last sitting, they told us, as long as you show us it can work and there is money, we'll come in all forms and sizes, and we'll come and finance. That would be my response.
I guess my last question to all is, what do we need to do? What partnerships do we need to put in place to see this off? And also just a parting shot from this conversation, so that I give it to the audience if they have questions to yourselves to ask you.
So do I start?
I'll start with you.
Thank you. For me, I'll look at it from 2 sides. One is the demand side for the warehouse to work. And I'm seeing a close friend I was chatting with just a few minutes ago, and I was talking about how can they play in and provide market or some kind of offtake during the pilot, and that is World Food Program. They are quite a big market for cereals and pulses. Because for this to work, there must be partnership from both the service providers, the financial service providers, and also the markets. How do we make sure that, for those who are capable of documenting lessons and fine-tuning the product, are able to do that? And for those who are able to, support the capacity like the way FSD and AGRA has done, both for commercial banks and DFIs, you support capacity to develop customized products for customized value chains. I think that, in short, would be my perspective in terms of working partnerships.
Thank you, John. Jackie?
Well, I would add the same thing. We need the demand side. So we've been engaging the millers as well, both the Cereal Millers Association and the United Grain Millers Association. And now we want to also engage with the WFP. So for the millers, it's key because they're the majority of the off-takers. So if they can now purchase the commodities off of the warehouse receipt system, it would now trigger or be a signal to the producers that this is the way to go. They'll be able now to store, to be incentivized to store their commodities in licensed warehouses, and they'll know that they have the end market in sight, which will then also trigger the financial institutions to be able to come on board much quicker than they are right now. So that's what I feel.
Thank you, Jeff.
I think in addition to off-takers, a key partnership is also, or a key player within this partnership ecosystem is the commodity exchange, offering a way for price discovery that is favorable to all parties, especially the small-scale producers and aggregators. And in addition to that, I would also say there is an opportunity for development finance institutions, global or other DFIs to come into the picture, providing that risk sharing or credit guarantee mechanism for to cushion this sector as it takes off.
Thank you, Rivans. Let's give a round of applause to the panelists. I guess I'll open it up to the audience. We tried to have this session short, focusing on 4 hypotheses. One is on value retention for smallholder farmers, traders, processors, wholesalers, and other value chain actors. 2, our readiness to implement the solution. 3, the collateral management, whether it's robust enough to handle this. 3 is the model that works, whether the cooperative model is one that we could onboard. And 4, the policy, whether the policy environment is robust. And of course, there's a couple of things that are in between. The report of this work should be released at the start of next year. But I'm welcoming you, the panel, in the next few minutes that are remaining. If you have any questions for the audience, if you have any questions for the panelists. Yes. Paul, I don't know how we are going to go about this. We just pick. Maybe we pick 5 and then, or 2, then we start. Okay. So yourself, the next person, just raise your hand so that we go. Yes, then Anthony, then yourself at the back. We'll start with yourselves. Go ahead.
Was this a trick? Oh, no, it's working. Thank you. My name is Asange Bang. Managing Director. Hello? Okay. Hello. The farmers, but then at the end towards the market, we're working with commodity exchange. So we have formed a tripartite arrangement where we are able to see all the players at the lower level now understand the importance of putting their crops together. And the best thing is we are fetching higher prices every time. So the thing is, this is possible to do. On the collateral management side, we have also we as a warehouse regulatory board will also taking care of identifying and giving license to collateral managers. It used to be with the banks, but again now the act says, the law says that we should be the one to handle. So we have advantage of making them work at the same time become collateral managers easier that way. But more specifically now I want to raise 2 questions. Number 1, in the process of doing this seems to be like a new phenomenon. Warehouse receipt system. A lot of farmers keep asking themselves, why do we have to get our crops into the warehouse? Why? What is the reason? What's the justification? On the other side, everybody else, the formalized arrangement feels that this is the safest way for the farmers to be assisted, especially smallholder farmers. I want
you, and thank you, the panelists, for the insightful discussion. My name is Anthony Mbidi from Family Bank. Just two questions from me. I think we've talked about the issue of smallholder farmer here and the warehouse receipting system. It is of course clear to everybody that a smallholder farmer as an individual may not have it easy depositing in the warehouse receipt because of maybe challenges with the cost and all that. Then you mentioned about the cooperatives, which is actually a sure way of getting smallholder to participate in this. But it is also another level that requires some preparedness. I don't know how prepared we are with the organized groups, especially in the targeted regions. And if we are talking about pilot, I know we may not be everywhere. We could be talking about the high potential areas. What is our preparedness with the cooperatives who aggregate for smallholder farmer? My second question is about the price. When I deposit on the warehouse receipt, I expect maybe to fetch better prices in future. But again, we know the cereals discussion, and especially the key cereal here is maize, whereby we've had sometimes government interventions bringing in stocks from outside Kenya, affecting the prices here. And also now there will be cost implication. There is, for example, financing costs. There is the warehousing cost. How do we ensure that that does not erode the margins that these farmers expect to get after they keep their products in the warehouse for the period that their cereals will be there? Those are my two questions. Thanks.
Thank you. Paul, I think we'll just take one more question.
Yeah, very briefly, because of time.
Yeah, thank you. My name is Rupsha Banerjee. I'm from the International Livestock Research Institute. So, of course, the question goes to all three of you. What kind of opportunities, if at all, do you see in the livestock sector? Because I think when you all were talking about agriculture, the focus was on crops. And I want to reiterate that agriculture actually is livestock, fish, as well as crops. So, and especially when it comes to both the extensive as well as the intensive systems, do you see any kind of business opportunity or a model that can work? Thank you.
Thank you very much. I think I'll start with Tito on perception of the farmer and the middleman situation. And then John, you'll take the second question in terms of the cooperative model and our preparedness for the same. And of course, you also take on the value chain selection stage. And lastly, Jackie, you'll take on Rupsha's last question. Thank you. Go ahead.
So on the middleman, certainly, this is a key question in this warehouse receipt system framework. In the absence, and I think has been alluded to in one of the questions, small-scale producers are not currently, due to the reach of the warehousing infrastructure, are not as able to deposit their produce in warehouses and would actually depend on some aggregator. The most optimal aggregator would probably be cooperatives, because one, if they're off-taking from these small-scale producers, they would do so at a price that kind of considers their interests. Cooperatives are, formed by the farmers themselves, and they would therefore then have some say in that, price discovery. And secondly, they could also have a mechanism of passing on the financing to the farmers should they opt out of the off-taker kind of way of taking that produce from small-scale producers. So it does, we are trying to essentially protect the small-scale producer from exploitative middlemen. However, in the long run, it is our view that with a wider adoption of the warehouse receipt system, that affects the volatility in prices, because farmers then have a mechanism of storing any glut, any excess at harvest time. And what then is taken or offered to the market is just what is demanded. So it then has the effect of kind of flattening that price across the year. And therefore, essentially, even if there are middlemen, they become just another alternative to the small-scale producer over and above warehouses and the cooperatives. And therefore, middlemen will not have as much power in dictating prices for small-scale producers as they have now in the medium to long term once this warehouse receipt system is fully functional.
Yeah, thank you, Tito, for that. Actually, just to add on his point, if you look at the more organized value chains like milk, the brokers are there, the middlemen, but they are price takers. They move with the prices that are set by the cooperatives and the whole mechanism. So that will be what will be the end solution when the warehouse receipt system ecosystem is ready and working. In terms of opportunities in other value chains beyond crops, yes, there are. When we did the survey with Agra, we went to as far as Mombasa, and one of the most interesting aspects was the fish and the seafood value chain is a great opportunity for this. How it can be done, as Tito said, is a new product. We are trying to learn using one pilot. Then we can see how we can scale. So there are other opportunities in other value chains beyond crops. And also in crops, there are numerous opportunities beyond maize and cereals, and other pulses. In terms of cooperative preparedness, I'll go back to the last question that you, Jared, asked. What is the essence of partnership? What is happening now through partnership that I mentioned earlier, including IFC, we are undertaking currently sensitization and trainings of cooperatives in the target pilot counties in Northern Rift Valley, and it is working. People are willing to come together and deposit, and they are seeing the sense of, having warehouse as part of their, the value chain management, reducing post-harvest losses, accessing better returns, accessing finance, and so on and so forth. So there are those who are prepared, and there are those we are preparing right now, of course, in collaboration with the Warehouse Receipt Council, Government of Kenya, Minister of Agriculture and Trade, IFC, Agra, and FSD. Thank you.
Thank you very much.
Okay, so I'll add to something that both my colleagues here have said. So on the issue of uptake by farmers, there's something that we learned early last year and towards the end of 2021 is the other big challenge is the issue of post-harvest handling. Because you cannot store poor commodity in a warehouse. It will continue deteriorating. So when we did the launch of the WRS in January of last year, we had spent a lot of time in Kitale, in Trans Nzoia, actually, the 5 sub-counties, and the rejection rate was about 86%. This is both smallholders in the cooperative societies and large-scale farmers, because a lot of, you talk to a farmer and they're saying, oh, we have this much that's going to come in. But when it came time to test before storage, high aflatoxin, yes, that was also affected by the heavy rains that had come in just as the beginning of harvest season. But there was also, they did not know, and in fact the demand now is they need to know what good, grade 1 maize looks like, what grade 2 looks like, and all of that. So we have had to do one step backwards and undertake and facilitate training on post-harvest handling to enable this produce to get into the warehouses. So that's the one challenge, to enable uptake. So that has been the demand from the producers. Then on the issue of traders, I think we've really vilified traders, but they play a very key role, and they can be used to play a key role. They can be the primary market makers, because there are some farmers who will not agree to store because they need money for immediate needs, and they don't have enough to be able to, there are those who don't have enough to be able to sell off excess. So they'll provide the liquidity at that particular point for those who want to sell off quickly, and then again at the secondary point where they're off-taking as well, again from those who've stored, to be able to sell off to their off-takers. So they can be inbuilt, and when we get more structured, then we'll have, the trading houses the same way we have, for coffee and these other commodities, because this is a bigness, and organize them in that manner. Then in the issue of imports, you'll be very surprised that the farmers actually know the cycles of when imports are coming into the country. So I remember having a conversation with some of the farmers in the North Rift, and they said, we know when the imports are, because they're neighbors to Uganda, Tanzania, so they know when they're coming in. So they said, we will not store at this particular, those who will not store immediately at harvest, they will store probably around February, and they know when to sell. In fact, they said, why are you telling us 6 months or 8 months? And we know, we want it for, why are you telling us a maximum of 6 months? We might need it for 8, because we know when the imports will come, the prices will go down, and then once the import season is over, the prices again go up because of the demand. So they're actually quite well versed. So the key thing would also be for any depositor to be able to know or to understand the value chain, because again, we cannot stop imports because of our arrangements in the East African Customs Union. Then on the opportunities, meat, there's a bit of there's a demand for storage facilities for WRS in meat and fish. The only challenge is the availability of cold chain storage facilities in the country, and this also affects some of the horticulture produce like potato. So we're trying to put in place investment portfolios and ask for the private sector to invest in this, because there's high demand. For instance, in Narok, they produce quite a lot of beef, but they bring it all the way to Dagoretti to the abattoirs here, because they don't have those facilities in that county, so they are losing out. So these are the opportunities that will be able to bring on board some of this some of these other commodities in place.
Thank you very much. Let's give another round of applause, please. And Paul, sorry, I know we've taken 2 minutes beyond time, but thank you guys for listening to us. I know Tanzania is way ahead a little bit. Yesterday I heard that you've traded at least $113 million from 8.3 million farmers, covering at least 6,000 cooperatives. So there's a lot of cross-fertilization that AL offers us in terms of even cross-learning and sharing our knowledge together. So if you want to talk to us beyond this, then we are available. Look forward to discussing this further. Thank you very much.
Yeah, thank you, Jared and the team. That was a very interesting conversation, focusing on the warehouse receipt systems. And we will move on to the next session. But as we do that, we have a video for you with some of the AgriFin partners who have been involved with access to finance. So kindly, the media team on that side, we can put in the video as we prepare for Jamie Anderson to bring on her panelists of the financiers, the financial service providers. I know in a way AFC is a financier in its own right. It was interesting to hear that. So let's go ahead with the video.
Hi, I'm Seema Gohil, the director of DigiFarm, Safaricom's digital agriculture platform.
My name is Jared Uchin. I work for the financial sector deepening Kenya. Currently, I serve as the senior agriculture specialist.
My name is Penina Wanja. I'm the founder and MD, DigiCow Africa Limited.
My name is Pius Sige. I'm the founder and the CEO of Amtech Technologies Limited.
Some of the key factors to consider for partnerships with financial institutions is first just understanding the risk profile and ensuring that you both have the same risk profile and willing to take the risks. Some of the other things to consider is also timelines. Are you on the same wavelength in terms of timelines? How quickly both parties can move? approval processes. So sometimes you might find with financial institutions, they might actually have more processes in place versus some of the agro-producers or agri-tech companies that we're typically used to seeing.
When developing a partnership between financial institutions and agro-dealers, we'll include the values of the agro-dealers and their visions. That one is going to be very critical. The second factor that we are going to consider is the sustainability and profitability of the agro-dealers. The third factor is the credit scoring for the agro-dealers, because this is very important so that you do not underfinance or overfinance. We are also going to consider the revenue streams and when they come, and also a consideration of the crop and livestock production cycle will be very critical.
So some of the very important key factors, one is they look at the risk, the agricultural credit risk, because in Kenya, we are relying on rain-fed instead of like irrigation. So everybody is saying, if I put in money here, the risk is very high. That's number one. Number two, they look at the lending rates. So the higher the lending rate, the farmers will shun that particular product completely. And then number three is the size of the loan that you are looking at. So it's very important to know the size of the loan that you want from the financial institution. And then finally, the type of financial institutions. You can go to a certain bank and the bank will tell you, our rate is this one and we can negotiate. Then some will tell you, please come to the table, and then we talk about it, and then we shall be able to come to, we make addition on that, and then we agree. The first thing that you need to do is to start early negotiation. You don't need to go like today and say, I need this kind of facility and you need it like next week. So start early negotiation. Number two, know the type of products that the farmers or the agro-processors requires. So if you are dealing with specific value chain like dairy, you know which facility you need and it has to be as soon as possible. Then number three is that is the innovation of the particular institution that is available. If you don't have innovative solutions, nobody will want you to that in that partnership.
The leverage points that exist in moving solutions forward with financial institutions, I think, are really bringing together public and private partnerships, specifically catalytic capital. I think banks and financial institutions typically, again, have like a higher risk threshold. And so bringing de-risking mechanisms into play have really helped us break through and move solutions forward. And I think it's brought both sides to the table and given comfort to both sides.
So the leverage points that are required to move solution forward is to be very, very innovative. Specifically, making sure that whatever you have for the farmer can be able to add value to that particular farmer. Because let's say, for example, Amtech having a credit scoring solution. So what are we supposed to leverage on? Basically, we need to leverage on the information the farmer we have by including even the farm level data. The farm level data means making sure that I know the number of acres the farmer has, the number of produce that you want to produce, and at what point will you get the money so that I get my money back, and also including the interest.
Some of those challenges that we've experienced, especially in this partnership discussion and or collaboration, is where the definition of what the project is supposed to do is not well discussed among partners from the get-go. Then you have misalignment of incentives that creeps up from the beginning that should probably have been addressed. And then number two, the pieces not necessarily fit in well from the get-go. And usually when the pieces do not fit in from the get-go, then you are carrying over something that from the word go never fit, the pieces never fit, and then you never discussed, as I mentioned earlier, an exit. In terms of how then we surmounted some of those challenges was, one is to have a conversation where you're bringing all these actors to harmonize that discussion, the discourse that was missed prior. And of course, there's a need to level expectations
better?
The primary one is really data and how to really share data in a way that you're respecting GDPR laws, but also allowing for both sides to co-create. So I think data sharing continues to be one of the biggest obstacles because we do really have to protect customers' identities, but also allow for innovation. So the other thing is risk appetite. Similarly, I think agri and investing in agri solutions tend to be seen as more risky. And bringing partners to the table, especially financial institutions, can sometimes be trickier because they don't have the same risk appetite. In terms of timing, it's hard to say that a single partnership unraveled at any specific point. I think different partnerships have had different challenges, some at the outset, and I think those are obvious ones that didn't continue. But we've also had partnerships that didn't work out post-implementation. And I think lessons learned from that is ensuring that, from the outset, you both have very clear goals, objectives. Both sides also have the same commercial goals, and I think that's been one of the challenges.
What is very important is trust issues, because whenever you are coming in with other people together, the first thing is you make sure that there is a very good handshake, collaboration between the two. So if there is no trust issue, that is there is a problem. Then number two is a common bond. A common bond means whatever we have together, we shall be able to get something out of the process. So that one also is very, very important, because if you don't do that, you can. Then the other thing is communication in between the actors.
Thank you very much. Over to you, Jamie, and the panelists.
Thanks, Paul. I'm really happy to be here, and I'm sure everyone else is too. Have you already found familiar faces in the crowd that you saw this morning, and that you're finding in the room? I hope so, and I hope you're as delighted to be here for this conversation as we are to be having it. The video was a great tee up, and also the conversation you had, Jared, with colleagues as well, about all of the issues that go into partnerships. And we're going to talk about them now with a panel of our colleagues from banks sharing their long expertise and stories and insights with us. To start, I'll introduce myself, and then I'll invite our panelists to do the same. My name is Jamie Anderson. I work at CGAP. We're a small team that sits inside the World Bank that focuses on financial services. We think about what makes sense for a financial service provider and what works well, what adds value for customers' lives and livelihoods. Inside of CGAP, I lead our work that's focused on rural and agricultural livelihoods. And that, at the moment, focuses in large part on how we serve rural women, because this is a market that we see that's largely underserved, and to us that means a business opportunity. So we're thinking about how can rural women be better served, and how can their needs for different products, services that increase their climate resilience be met. And of course, partnerships are at the center for us. Like Sieko was saying in the morning, we have a great team, but we're only one team, and we're a small team at that, and working at these very intersectional topics on financial services, agriculture, gender, climate. We can't do everything, and partners are critical to us when we're thinking about working at the systems level. Just one quick example, and then we'll go to our panel. Right now, one of our key partnerships is with IDH. We're working on a coalition called ABERA, and you can check us out at the marketplace. But very briefly, ABERA stands for Accelerating Business to Empower Rural Women in Agriculture. And we're pulling together partnerships with a select group of financial and agricultural service providers, all very much with a business focus. Our work is to boost their business performance and also help them achieve some very specific goals on climate and gender. So again, that's the very definition of working in partnerships. And it's not easy, as we all know. That's why we're all talking about it. There's no one recipe for what makes a good partnership. It's not always clear, like I think you were saying in the video, Jared, what looks great on paper doesn't always translate in the field. So this is what we're here to talk about with our esteemed group of panelists. We'll start the conversation with asking you just for a quick introduction. Paul, let's start with you. Tell us your name, your institution, what you focus on.
Thank you. Good afternoon. Thank you very much. My name is Paul Odom, Head of Projects at Equity Bank, specifically from Uganda. And I work in the Social Investments Unit, which is from the subsidiary perspective. This is the Equity Group Foundation department. So specifically oversee the areas around the pillars of agriculture, programs in social protection, programs with financial inclusion in terms of financial literacy, and also in the areas of health and other significant sectors that we focus on from a social investments perspective. Thank you.
Thanks, Paul. Houston?
My name is Yusta. My name is Yusta Segete from NCBA Bank within the FinTech arm of the bank called Loop DFS, Loop Digital Financial Services. I head ecosystem business. We look at a number of ecosystems, digitizing them, and providing financial services within those ecosystems. Our key ecosystem that we focus on is agriculture, where we are working with smallholder farmers in Kenya and Tanzania for now.
Great. Thanks, Houston. Anthony?
Thank you. My name is Anthony Mbidi. I head the agribusiness unit at Family Bank, overseeing ag finance across all our 94 branches and cutting across all the segments from the smallholder farmer to the corporate agribusinesses. Thank you.
Wonderful. Thanks, Anthony. So we have quite a bit of expertise in the conversation. And what we'll do is I'll ask a few questions, and then we'll invite you to ask a couple of questions as well. So be thinking about what questions you want to put to this group of bankers. Think about your own initiatives, your own partnerships, and the questions that you want to ask. So what we're going to do is we're going to start with struggle, and we're going to move to success. But first, let's talk about what you've learned, because there's a lot to be learned from partnerships that don't work, that don't turn out the way that we expect. So I was wondering if you can start with a story of a partnership that struggled, that didn't work out the way that you expected. Was there a moment, whether it was in a meeting, in the field, somewhere, was there a moment when you knew that things were off track? And then what happened? Were you able to, was there something you did to break through? Did it recover? How did it unfold? Yusta, let's start with you.
Partnerships that failed, I think we have more that fail than the ones that succeed. So I think I recall one partnership in Tanzania where we were planning to fund sunflower farmers in the area of, like we said, no naming names. So we engaged with a partner who happened to be an agri-tech. They provided data for the farmers that were to be involved in the pilot before we could roll out the program. So we sent our teams both in Tanzania and Nairobi to Tanzania to engage the farmers, collect farm level data. So the kind of financing we do at Loop DFS in agriculture, we really don't focus on the traditional financial data like bank statements and collateral. So we focus on mainly contract financing where the contract issued by the off-taker is sort of our soft collateral. And then we organize farmers into groups, bring together input providers. We have agri-tech sometimes who aggregate the inventory, the various inputs required by the farmers. So we brought all the parties together, including crop insurance, everybody who needed to participate in that value chain financing. So went to the ground, collected data, engaged government, and I've seen our brothers from Tanzania, a few of them. The government is very involved in agriculture, very supportive. So when our team arrived there, I think some of the local authority, sijui mnawaita ni dio ama dedi, they arrived there and like, so where are you from? What are you coming to do here? Of course, we introduced ourselves, engaged the government officers, and we told them what we were about to do. We had recruited local agents there to work with the farmers, to recruit the farmers. So everybody was there. We had a demo farm. Sunflower farmers had already seen when, say, the right inputs are utilized, the right gaps, the quality of product that the farmers were gonna harvest. So all that was done. So we did our work, engaged stakeholders, collected data, came back, provided the data to our data scientist team who did the algorithm. We were very new in the space, in agriculture. I mean, our core business has been B2B partnerships in the telco within the fintech side. So we understand that area. There's lots of data. We've been doing the business for 10 years. So this was agriculture, first time engaging in agriculture and trying to fund, maybe for those visiting, our legacy or anchor product is M-Shwari, where we provide digital credit across, the telco players, mainly Safaricom, and in other markets we have all these other players. So our data scientists have been working with data, but this is really telco data. We have lots of payment data. So with the farmers, there was a lot more to work with. So there's farm level data. These farmer, some of them didn't have much, except this is where I belong. So we did our data. We scored. We were to do a pilot of about 2,000 farmers. They gave us data of about 5,000 farmers. So we managed to score, and of course, not much data compared to the partners that we've been working with in the telco. We were only able to score about 500 farmers that could actually qualify for the credit, and we were looking at credit between $200, $300 per farmer per acre. So we had already scored, gotten capital from our finance team to be able to finance the pilot, opened all accounts required, and now started onboarding farmers. Then midway, the government of Tanzania, like I mentioned, very supportive to the farmers, introduced a new regulation that all fertilizer has to be procured directly from the government. Our agri-tech that we were partnering with had already procured fertilizer. And the government is here, Dio, and Asema, Daddy, we cannot, you cannot provide farmers with this fertilizer because government has provided subsidized fertilizer. So that really changed the business model. The agri-tech that had already procured and were in the process of procuring more inputs from the other input providers, I mean, the partnership really collapsed because the agri-tech actually, one of their business model is to make, how they commercialize the model, is to make, they sell the fertilizer to the farmer at a small margin as much as they procure it in bulk. So the government legislation really collapsed the whole partnership. We had not seen it coming, and we thought we'd probably have some heads up that this is coming. So maybe you have already procured, you've scored the farmers, maybe provide credit to this group of farmers with the inputs that you have financed, then maybe second round work with the government subsidized fertilizer. So the whole model collapsed on that because then the biggest input that we were going to finance was fertilizer. So that is, I can say, is one partnership that failed. To date, we are still looking at what else can we do in that space. Having recruited farmers, we have all this data, and we have all this regulation that has collapsed the whole model. So I would say that's one that I can remember very recent. And we are still looking at this partner, how else can we work together?
Thanks, Euster. And thanks also for your honesty about the fact that, you know, in some ways there's so many things that need to line up for a partnership. It's exceptional when it succeeds. So, you know, sometimes when it doesn't work out, we're a little bit reticent to talk about it because it's maybe we don't want to put any shade on the partner. We don't want we don't want to speak ill of anyone we're working with, but it also, we lose an opportunity to learn what happened as well. So thanks for sharing that with us. Paul, what about from your side, one of the partnership that was a struggle?
Thank you. There are quite a lot of them. But I'll just speak, I'll pick like more of a case study because they have all one common aspect. So from a partnership perspective, I think the key question that both parties are always looking at is what is in it for me. Now, one of the key challenges that we have had is that being perceived as a financial institution and not from the social investment perspective. So most of the time, one of the things that come in between this is from the social investment perspective, we get into this partnership for social transformation. But of course, we also look at it must be sustainable for either party. So there are always those aspects. Very recently, we have been we struggled with one particular partnership because of these aspects. So we launched, or rather we set out to be deliberate from a financial institution perspective to partner with fintechs. Because from a strategic perspective, we are looking at this as the which will help us to drive the strategy, what we are trying to do, especially in terms of financial inclusion. Because we realize that as a bank, from a conventional perspective, on the economic side or the banking side, we need to, we have the strategic goal to reach more and more customers and bring this financial inclusion. But we cannot do it alone as a bank. We need to partner. We need to work already with established agri-techs, institutions, development organizations who have done a lot of work in already mobilizing and bringing the smallholder farmers together. So there's always the missing link is the access to finance because of the financial institutions, the restrictions that are in. And also on the other side, the agri-tech or the fintech may have, or these particular organizations may also have their limitations, may probably from a point of view of the license perspective. So we come in to bridge that gap. So for this particular partnership, it took us quite a long time to first of all do the convincing of this partner to come on board to work with us. And yes,
you had to convince the partner, or you had to convince your internal stakeholders?
It was more convincing the partner because there was a belief that we have tried this before with financial institutions, doesn't work. Yeah. So, and what different aspect or perspective is Equity Bank offering? That it was more from that perspective that banks are not really very serious actually about working and extending credit to these smallholder farmers. They maybe want to deal with the other segments where there is probably a guarantee of repayment and that kind of thing. So we finally started working together on this particular partnership, but it was problem after problem after problem in the field in terms of lessons learned, in terms of tools, equipment, but most of all also looking at the limitations around the financials, the commercials. Like I said, what is in it for us and what's in it for them. For us, we are very keen after the numbers after reaching more and more people and extending this opportunity. Okay, but of course it also has to be profitable for this fintech. So I think for me, one of the key things that we realize that it's from the output. Okay, so when we realize that we have this large number that we are targeting and hopeful that actually we are going to get it, but when finally went to the field after a lot of negotiations, alignment, and talking about convincing about the trust issues, data sharing, eventually now the numbers started trickling in, but they're really very, very minimal. So when you realize that now, I think we need to look for other alternative ways to actually work together with this partner to ensure that we achieve what we wanted to do. By the bank going out of the way to actually support on certain areas where they were struggling, especially in terms of onboarding the customers. A lot of things to do with, of course, even the capacity building, the training, and engagement on the models, the model that we can use to actually make sure that this particular project succeeded. Yeah.
Thanks, Paul. Anthony, there's some themes coming through in what you, sir, and Paul are saying about trust, about profit sharing, data, organizational culture. Does this resonate with your experience of partnerships that have struggled?
Well, very much, although I have a different, slightly different story from where I sit. I think 90% of my work revolves around partnership. I deliver through partnerships, and so I've seen the good and the ugly side of partnerships. But one of the most memorable ones, and which is actually very recent, is where a partner comes to pitch, seeking for partnership. We buy their idea. They promise so much. You go through all the rigors of bringing on board a partner, which is not easy in the financial industries. We go through all that process. You get the chance to be approved, and then we hit the ground running. Then this specific one failed on the data side, whereby this partner had promised us huge data of the target of the segment. But then when we had already signed the agreement and we roll out the program, it turns out that all this was just for them to get business. And then it turns out that now it is not them to provide data, it is us now to provide us with the customers who are in our database so that they can start talking to them. Well, of course, I don't need to say more, it died. Of course, it's very frustrating when you try to figure out all the pitching that sometimes partners do to us. The processes that we go through to bring that partnership to life. And then when we expect as a financial institutions to start reaping from this partnership. And of course, our role is to provide finances. We are experts in that. We may not be experts in the other side of things. So we are counting on this partner. But then again, it turns out that this partner was just lying. And so the issue of reputation now comes in. And so if there are potential partners sitting in this room and you happen to approach us and you find it difficult, you find us difficult as we are often referred, just know that we have learned. We've been through hell sometimes with partners, and that's why we really don't just take in partnerships casually. You'll be subjected to a lot of due diligence, and by the time you get on board, then we want to be sure that you can be able to deliver what you are promising in those pitch decks. Thank you.
Thanks, Anthony. Yes, sometimes there's quite a difference between a beautiful pitch deck and what's actually happening in the field. Thanks for that candid reflection. Anthony, let's stay with you and let's move more toward the positive, where you see there's success. Think about, to your point, think about your ideal partner. How would you describe them in 3 words? Tell us 3 words and why.
Thank you. I think financial institutions, we are very sensitive institutions. We are custodians of customers' data, confidential information and all that. And so anybody coming to us as a partner, you must be very reputable. Okay, so due diligence precedes everything. The moment you start talking to us, we subject you to due diligence. And sometimes we may even ask you for documentations that most of you may not be comfortable with, but they are very necessary for us to make a decision on whether to continue to the next steps with you or not. Secondly, I think innovative. We want somebody who can fill the gaps. We are not experts in everything. For example, if I'm serving smallholder farmer segment, and this is an input financing kind of arrangement, I may not be an expert in distribution of inputs and all that. Do you have a solution towards that? So you should be able to fill the gaps that I, as a representative of my financial institution, I am not able to do that. Then impact also now, especially when we're talking about, I know there will come, the revenue discussion is always there. The bank wants its cut, the partner wants its cut, but how do we balance so that our interests also don't really overcrowd the interest of the target customer? So that means that we have to exercise some level of flexibility and give and take kind of attitude in that. Yeah.
Thanks, Anthony. So I'm hearing reputable, innovative, complementary, and having impact. Euster, how does that sound to you? What would you say are your 3 things you're looking for in a partner?
So at Loop DFS, we look at a partner who can scalable. They have a customer base that even if at the time of contracting or partnership, they don't have as many customers over time, we can be able to scale, noting the ticket sizes that we lend are really 5 acre and below. So we'd like a partner who can scale. Number 2, we prefer to work with farmers who are digitized, in this case agri-techs, who have some level of digitization, can connect to us through APIs. We are able to do digital onboarding and KYC, so that would be an ideal partner. Number 3, we are also looking at partners working in structured value chain or crops, such that we're able to follow the money trail from when we provide inputs to the farmers to when we get paid by the off-taker. So those will be the 3 key partnership that we look at in terms of onboarding a partner.
Okay, that's really helpful. I hope you all are thinking about your questions and doing a little self-reflection about scale. What else did you say, you Stuart? Digital value chain. And this gives you a good window into what these banks are looking for. Paul, from your side, how would you describe your ideal partner?
So more or less the same. Maybe I'll just concur, especially on innovativeness and an innovative partner. Many of these partnerships that we have gotten into, because for us to drive that for that innovation agenda, because we are dealing with the people, we want us a solution may work because across the group, it may work in Kenya, it may work in Tanzania, but it may not work in Uganda, but it's the same solution. So sometimes, actually one partner asked me, why has this worked we have worked very well with you in DRC, but it's not working here. Where is the issue? So I think now that means that the partner was coming with the mindset of the other market, not looking at specifically the market here in Uganda, but they offer the same innovative solution, which is going to affect the smallholder farmers. So I think innovativeness and adapting to the local situation and the needs of the local communities and the smallholder farmers that we deal with is key. Number 2, I think it's more sustainability. I want a partner who thinks about sustainability. We don't actually get into partnerships which are not sustainable. Sustainable in terms of, actually that's one of the key things that we ask for and look for. If we complete this partnership, what happens? Does it end? If you are doing it as a project, does it end in project? If the answer is yes, then we don't take it on, because we should be able to carry on with that, and with that is social intervention that we are doing as business as usual rather than as a project, because that's what we want to see, and that's what we look at, socio-economic transformation of the people and the livelihoods of the people that we are working with, because it's in our vision. So without that, then we are not aligned strategically. Then maybe the last part, of course, speaking to that, there's an element, I think he spoke to it, about the trust. Yeah, that is actually very key, because what you bring on the table, I've had one partnership which was big with a big reputable organization, but I think from this even happened before I joined. But at the time when I came in to implement, and was also dealing with smallholder farmers, it didn't work out because the management felt cheated, like you mentioned, that we were promised this 60,000 or 100,000 farmers in this period of time. 6 months down the road, it's not there. So I was just told, kill the project, because from the onset there's no trust. You promised to give me this, it's not there. So those are key elements that we look at. And at some point, we have to take a deep dive and look at pause onboarding partners, but look at what value are we getting out of these partnerships, and in terms of our strategic vision, are we actually delivering in the socio-economic transformation of the people we set out to do? So that check is there to ensure that everything is sustainable. Thank you.
Thanks. That's really helpful, Paul. You know what's fascinating about this list that's coming together? There's innovation, context-specific, sustainability, trust, scalability, digital, complementarity, and so forth, reputation, impact. There's no mention of revenue. And maybe you're all being very polite. And you're not bringing up something that's obvious. Of course, it needs to make sense for you. It needs to make sense for the partner. But it sort of goes to the conversation that we were having with Gerald and colleagues, that someone said, oh, for the commercial banks, you just show them the money and they show up. That's all they're interested in. Is that the case? Is that maybe, Paul, when you're talking about sustainability, there's that revenue wrapped up in the sustainability, and fair enough. But I'm just wondering if you could respond to that. In other words, there's an impression of commercial banks that you're risk averse and you're just in it to make money, just in it for the business. But that's not coming through in what you're saying here. So how do you respond to that?
Yes, actually, that is a very, if you remember, one of the things I mentioned in the beginning was the commercials. Is why we struggle. But I think once we define this from the onset, truth be told, no business, or if you look at it from a banking perspective, you don't want to create another bank within a bank. So the approach in terms of the revenue sharing and how it is structured in the beginning is actually defines how the success of that particular program. So most of the time we are flexible. We can say revenue share, though the bank may shy away from that for obvious reasons, because depends on, like I mentioned, from the onset, what have you defined and what's the value proposition from each, from the bank side and also from the partner. But if a solution really works, we look at more on the transaction share and making sure that yes, let's do this solution together. You have innovated this solution, we have worked on it together, and then we see how and then we agree on how we are going to actually show that. But when it goes into the idea of creating a bank within a bank, that becomes a very difficult conversation. And we actually had that discussion. We engaged a lot of fintechs. We actually had them with another development partner who moderated at the time. What's the real issue? Why can't you sign up with the banks? And the issue of the revenue share came up, and they say the bank doesn't want to share the revenues. Maybe we do all the heavy lifting, but when it comes to the transaction cost and whatever, but this is something that we can build within the model that on a case-by-case basis, so that ideally it ensures that the whole conversation, the whole partnership is sustainable, but also it is something that the bank can support in the long run. Because at the onset, it may look okay, you say 50, 60%, but now as say you look at maybe probably how the transactions growing, then it becomes very, very costly even to the bank to run such a model. So that has to be looked at in detail and addressed structured in the model that you agreed from the beginning.
Thanks, Paul. We're going to come to our last question for the three of you. We'll have time for a couple of quick questions from the audience. Just a very quick response from the three of you. Again, thinking about success, looking ahead at the horizon, what opportunities do you see in front of you where you know you need partners? There's something exciting afoot, but you need partners, collaborators to work with. Can you give us a line on what it is and the specific kinds of partners you're talking about? We talked about the general qualities in the last question, but more specifically, what kind of partner are you looking for? So Anthony, set up the opportunity and tell us who you're looking for.
Thank you. For us, we are now getting into inclusive finance programs as Family Bank, targeting smallholder farmers in different value chains. We don't want to do this in the conventional manner that banks do that. So we are having a digital approach towards this. And so any fintech that is playing in that space and that can fill the gaps that we want is most welcome to work with us. We know it's a risky segment. That's why financial institutions keep off it. And so any de-risking kind of support from the partners is also most welcome. We are ready to work with any partner. The revenue sharing notwithstanding, I think what we lose through revenue sharing can easily be recovered from the reduced cost of doing business, especially when we go digital. So that is our strategy. I've given you a leakage. I think if you're in the room and you're interested to work with the journey with us, you're most welcome. We can have a conversation. Thank you.
Thanks, Anthony. Yusta?
So for us, an exciting space that we started and still looking to scale is working with other fintechs. Really across the various ecosystems we are working but more specifically in agriculture, we are looking at agri-techs to partner with. Like I mentioned earlier, we are looking at agri-techs that can scale. You may not have the numbers now, but you have possibilities for scale. Again, we are also looking at sustainability as well. As NCBA Bank, we launched our sustainability agenda early this year. So we are also looking at partners in that space. Again, there is one of the value chains that we launched in Kisumu in rice farming schemes. So we have a lot of lessons so far learned, as much as it's still ongoing. So one of the areas that we really want to focus on is group lending, where farmers come together in groups organized in CBOs. And then we are able to lend to the individual farmers and our group. We are finding those models very effective in terms of accountability and ensuring that the farmers are really rallying each other. If we are collecting seed and we need to plant seed, they are all planting as a group. When it comes to, say, applying fertilizer, they are also doing it as a group, ensuring that they are following proper agricultural practices. So that's a model that we are currently more biased on and still learning quite a bit of lessons. The individual ones, we've had a few failures here and there, but the group model is looking like something sustainable in the long term. We started a pilot with about 1,500 acres, all in smallholder farmer. We are looking to scale it to about 15,000 farmers in year one alone. And the group model is looking like a model that is more sustainable. Like my colleagues mentioned, we as banks are looking to be in this space 5, 7 years. Not projects that we are going in 1 year, we burn our fingers and we are out. So we are also looking out for development partners in this space, especially within the credit guarantee space to help us de-risk. Noting that we are not doing traditional banking, we are working with alternative data, which a lot of times is not available. So we have to throw money at so that we can just collect data, and over time we are able to refine our scorecard. So we are really looking into working with development partners to be able to build a better scorecards, collect more data, which is a process that may take a year or two before we can get refined data. If, say, I look at our M-Shwari business that we've had it for the last 11 years, we started with really very minimal data, and our NPLs were running upwards of 20 when we started. We are now doing about 4% NPL because we've been able to collect a lot of data. We've become better at credit scoring. So we'd want to do the same for agriculture. However, the risk is quite high, and like we mentioned, the revenue is really key. We are working with shareholders who are very keen on return, and they are getting return in all other sectors, and agri is a space we're really convincing them to play. So a lot of partnership, DFI support will go a long way in terms of building that sector and being able to scale it and being there longer.
Great, thanks, you, sir. Paul, opportunity for you on the horizon and the partner you're looking for, then we'll have 2 quick questions.
Yes, currently we are working actually from a strategic perspective. If you've heard of our Africa Recovery Resilience Plan, we target to reach about 100 million customers. Okay, it is an uphill task, but we have, and the only way we can reach that is working with the partners. And the exciting opportunity where we're working on right now is with Agrifin, in terms of especially doing something innovative in terms of using alternative data. We, rather than using the conventional data, banking data, how do we extend financial access to the smallholder farmers digitally? So we're working very closely with Agrifin on that, and we do believe that this is something that will be very revolutionary in terms of, it's not something that we have done conventionally, but it's something that we are trying, we see that will help us reach these smallholder farmers and these or traders even, for that matter. But to be able to achieve that, again, as my colleagues have mentioned, I think we have already these the farmers or smallholders, traders, coming together in their respective cooperatives, circles, or even out there, in even difficult to reach areas. And then the only thing that they have is access to maybe a mobile phone. The nearest bank or branch is hundreds of kilometers away. We're doing a lot of work with the refugee communities and the host communities. These are the kind of people that they need these financial services. But what does it take for you to get a loan in the bank? The bank must know you for some time, or have some information about you, about your farm, about something about you that can help them make a decision. So what we are working on in this project is actually develop those alternative credit scoring models that we can use the data that is already available out there and rely on it to actually make a decision to provide this financial service. So it is something that we have started. I can say it's we're still in the learning how basically how is it going to work with the help of Agrifin. So that is the opportunity that is available to partner with the fintechs, the agritechs, to bridge this gap, because they have already this data and this information. And another opportunity, of course, as a bank, of course, we need this data, but probably it may not be a good idea to partner with every fintech. But if they also there is opportunity of aggregating this data, not for the banks to consume, probably as you mentioned about revenue share or something, that is somebody out there aggregating data from all the fintechs, so the banks just come and pick the data they need, a credit score, and they utilize it. So that would also be good, something that would work in a sustainable manner. Thank you.
Great, thanks, Paul. So rich partnership opportunities on data. We're out of time nearly, but we have time for 2 quick questions. Yes?
Okay, so I'm going to be selfish briefly. We have brought 120 farmers from 40 farming communities in Kenya. They're going to be here on Thursday. Please come and spend time with them, ask them questions and have conversations with them. They're here between 10 and 4 p.m. So my question to you is, we operate, we're an ag tech, right? I run a company called Kwamana. And we've managed to figure out trade financing beautifully. But there are a couple of things that have been a challenge, like input financing, for instance, and now equipment financing. And for 2 reasons, I think, that you already mentioned. The first is on input financing. We procure input with agri-dealers, but what happens is a month later, the government floods the market with subsidized input. And then we've introduced lease-to-buy models, for instance, in Nigeria for solar irrigation pumps. But now, all of a sudden, there's an NGO giving out subsidized solar irrigation pumps. So, of course, for us, it's not business viable. And it means we can never work with a lender to support farmers in doing that. There's a risk to the sustainability of it. My question to you is there any conversation happening with like government, banks, and NGOs to kind of, I'm not saying don't give subsidized things to farmers, because some of them need it, but to kind of align on these things that are happening to prevent businesses from falling apart because of these interventions. Yeah.
Thanks. We had one more question on the front table.
Thank you. My name is John Mungai from Agricultural Finance Corporation, DFI. In all your discussion, I have missed to hear an opportunity on partnerships with public entities, DFIs, especially how we can, as having been backed by the government, how we can work together. We provide the de-risking aspect, and you provide a more quote-unquote safer investment or lending. So my question is, do you see an opportunity in partnership between you and DFIs in your countries? And what kind of partnership do you see, if there is any?
Thanks, and let's combine those a bit. We can talk about dialogue with policymakers, public sector, regulators, and then possibility for partnerships. Yusra, do you want to start?
Yeah, I could take that. So when it comes to government partnership, we actually reach out to government for partnership. We've been trying to work with an AFC, I mean, you're one of our partners, to try curate a guarantee very specific to agriculture. However, the private sector moves much faster than government. So over time, we believe that, and I know there are a number of initiatives that are being done by government to have, say, private entities like AGF or other development partners run the government guarantees. Those would be very good initiatives to be able to fast track the process, since the commercial banks are revenue generating with targets, and waiting for government to implement takes time. So it is our wish that we would want to work with government. I mean, I look at a project, like I mentioned, we're running in Kisumu. Government is really helping through National Irrigation Authority, making sure that the land where the farmers are farming has enough trenches, water in terms of flooding. They'll be able to put in all that drainage and really support it. And we are succeeding because of NIA has done good work in terms of rehabilitating the land. However, it takes time. So for me, I would suggest that more talks. I know we are talking more. We are trying to see how can we help government fast track some of these initiatives, maybe by partnering with private entities to support government in terms of fast tracking, if it's credit guarantee, if it's the subsidy process. We've had instances where farmers wait for the subsidized fertilizer, and we are ready to work with the government through NCPB to purchase the fertilizer. However, sometimes may not come in good time, noting that farming is very seasonal. You delay by a month, you're already out, you've burnt your money. So I think more partnership with the DFIs to support government initiatives is a move we are working towards, and really looking to grow in that aspect where you can be supported to fast track.
Thanks, you, sir. Anthony, do you want to build on that?
Yes, I wanted to take the question around government subsidies, especially around the area of input. And this is a live example. I'm currently implementing a program supporting input financing for smallholder farmers. When it comes to government subsidies and our role as financial institutions or private sector, you'll find that there is always that gap that you may need to fill. For example, the government of Kenya is running a fertilizer subsidy program. In my program, part of the package for the input is actually fertilizer, which is commercial. So it means that it's more expensive than what the government is offering. But when we went to the ground, we found that one, the government depots are very far away from the farmers. So much as there is that subsidy, the cost of getting that fertilizer from the central depot is high. And so the farmer ends up spending a lot more. Secondly, there are areas that the agronomists have advised that this planting fertilizer or this top dressing fertilizer doesn't work. Yet it is, the government is providing generic solutions to all areas across the country. So you intervene and give them what is recommended for their region. And because we work with soil testing agencies, they know the best kind of fertilizer to be used in such regions. So the farmer will not go for the subsidized fertilizer because it won't work in their situation. They will want the other fertilizer. Now, we also now make sure that our solution involves last mile delivery, such that the farmer will get that fertilizer at the nearest point. And so we spare them the transport cost. At the end of the day, they find this one a bit more attractive than even the subsidized fertilizer from the government. Yeah.
Thanks, Ajay. Paul, a quick last word building on that.
I think I would speak more of, on the partnerships with the DFIs. And I think for us, that is what has really worked for in terms of growing our social investment. Basically, in terms of de-risking, and also looking at from the market perspective, some of the things to do with the credit guarantees, risk sharing partnerships. In some instances, of course, there are those grants, but I think it has been a mix of both, but largely it is what has helped us to move and scale most of the products that we are having, especially in our target customers in the micro sector and all those hard-rich areas, and also those especially supporting our programs in social protection and these communities, vulnerable communities. So working with the development, financial institutions, and also with government in these areas has really helped to bridge the gap in terms of financial access. And it's one of the, those are some of the partnerships most of the partnerships that we hold very dear, and we try always to ensure that they work and we all derive the social benefit to the communities that we are serving. And we commend the partners that we are working with in those respective areas. So it works, and it has helped a lot to bridge that commercial bank thinking more to the social investment, and also helping the communities access these financial services. Yeah, thank you.
Wonderful. Thank you so much. Please join me in thanking our panelists, Paul from Equity, Eusto from NCBA, and Anthony from Family Bank. Thanks a lot for your candid comments and reflections. And Paul, back to you.
Yes, thank you very much, Jamie and the panelists. I would take this opportunity, because of time, to invite Rupsha from ILRI. She has a very interesting presentation with regards to what they are doing on the innovation space. So, thank you very much. So we'll have one more presentation and maybe just a brief interaction before we head out for lunch. Let's put it up. Yeah. This was yours.
So, do I get to control the slides or the slides?
Yes, and there's a, let me show you. Sorry. Control the green and red.
Okay. Okay, so I hope everybody can hear me. So good afternoon, and I'm sorry to be the last one between you and lunch. Usually that's the case, and then you're rushed. I was said that I would be given 10 minutes, but I am going to take at least 15 because I think it's a bit unfair to put that pressure on me. So we've heard since morning a lot about the agriculture sector, but primarily about crops. So I'm going to shift gears a little bit and take you to the world of livestock, and mainly on drylands. My topic does say farmers, but in the interest of time, I'm going to actually skip the part on the farmers because I think we've heard enough for today, and I'm going to actually talk about livestock for a change. So the reason why this slide is important, though it just has my name and the topic, is also the going back to just the conversation that just took place right now. On the right-hand side, you can see a volley of names and logos. So these have been all our partners since the time we actually started this work around de-risking in the drylands, and there are some of them who are in this room. Like, for example, FSD was our very first partner who gave us the seed money to try out something in the drylands on coming out with a financial product. And Equity Bank was actually our first implementing partner in the county of Marsabit. So I just wanted to acknowledge the presence of them and the fact that we have a very long-standing relationship with them, and we hope to continue it going into the future. So basically, very quickly, challenges and opportunities in the livestock sector, and actually this is both an issue as well as a very big opportunity. The fact that 1 billion people are dependent on livestock is a huge population, not just in this country, but generally in the region, and also I'm sure it is much more in the continent as well. But the fact also remains is that they face multiple climatic hazards, and have all witnessed that in the very long protracted drought that has taken place, and now El Nino at its best in the northern regions, if you are up to speed on what's happening over there. And as a result of that, the major risks actually come in relation to markets, storage, inputs, pests, and diseases. As much as it is relevant in the crop sector, storage and inputs are equally relevant in the livestock sector, especially when it comes to feeds and also other livestock products besides milk, other than hides, skins, and so on and so forth, and even processed meat. The unfortunate part is that a fraction of climate investment is actually allocated to research and development for livestock-based systems. And also, I also want to point out that as part of the partnerships and as also part of evidence generation, and also in terms of getting new products and innovations on the ground, research is a very, very important component, and that is what I'm here to demonstrate today. Having said that, what the reality also is that provision of market-based financial solutions can actually have positive influence at the household behavior and welfare, and more so, innovation through digital technologies for collecting, sharing, as well as even ground truthing data can also be quite a game changer. But it has to be context specific, it has to be based on advisories, and also it can be scaled up with different ICTs elements as well as different partners and partnerships. One such example that I talk about today is livestock insurance. This is a program which was actually conceived and designed in the International Livestock Research Institute way back in 2008 as a kind of a response of getting financial products out into the drylands and especially to the migratory pastoralists as a way of de-risking drought-related risks. Very quickly put, because I can spend like a whole day over here, so how does it work? It's basically a pasture-based index where if the pasture levels or the rangeland falls below a certain threshold, triggers are a payout is triggered, and then the payout can be used for buying feed, fodder, household items, and in veterinary services to keep the livestock alive. As a part of that, we now assume that livestock is basically the asset, and it is primarily targeted for the drylands and the pastoral communities in the extensive systems. Very quickly, so the role that ILRI so far has played has not only been the research and the technical support, but it has also played a role as a catalyst of getting all sorts of partners in terms of academia, donors, governments, and so on and so forth. And one of the testaments has been the progression through which we have started. So we started in 2010, and through many steps of being adopted as a Kenya Livestock Insurance Program, which probably some of you all are familiar with, and also reaching to the regional level of having commitments from the IGAD nations on having livestock insurance as part of the disaster risk mitigation strategy. In 2021, now it has taken a new shape and form in the name of DRIVE, which I'm sure a lot of people in this room are aware of, which is a very big regional World Bank funded project. In all of this, partnerships have been a very key role, and as we heard today, that partnerships, though they were difficult, but they have also been very rewarding. And just to get a snapshot of currently what we are doing, and like I mentioned in the earlier slide, that we have always been partnering and been working with everybody, because that's how things get done. That's how scaling gets done. So currently we are working with a myriad of partners, and of course one of them is Spark, who's also one of the sponsors of this program. And in addition to that, we are Kenya and Ethiopia kind of like our kind of our laboratories, we might actually want to call it. And then we were scaling in Sudan, but unfortunately the war started, but we still have hopes that we can go there. We are going into Somalia, as well as we are also now planning to go into Senegal and use this as an entry point into West Africa. Why is all this important is that because as we are going there, we are also innovating, and we are also looking into see how livestock insurance or insurance or any kind of financial products can also play a role when it comes to conflict mitigation and peace building in these regions, because conflict remains one of the challenges, but at the same time it also gives us an opportunity. Very quickly, because all of these products, if you have to show impact and if you have to show evidence, you need to have actually the facts. So basically, as ILRI, we have been collecting data for a very long time, since 2010, on the behavioral changes and welfare benefits of insurance and financial products. So currently, then when I say 75,000, this includes both the commercial product, which is solely and wholly sold and implemented by the financial companies, and the social protection programs, which is implemented by the governments of the countries that we work in. So currently, we have about 75,000 policies in both Kenya and Ethiopia. About more than 100,000 people who have been covered. Women are actually 43% of the policy holders, and this is one of the reasons being is that a lot of them actually insure their small ruminants. There has been data to suggest that 36% of reduction happens in distress sales, because that's one of the instincts that usually people have, that the moment that there is a drought or a shock, the first thing that they do is to sell their livestock. We've also seen that it actually has nutrition values, and more than anything else, we've had payouts close to $11 million since all these major drought years. What has been done with the payouts? So we did studies to actually see that these payouts have been used, especially when asked the question that if you had the payout and if you did not have any other resource, what could you have missed not to do? So basically, through the payouts, they have actually invested in food, buying feed and fodder, veterinary services, and also paying off credit. Why is this important to suggest is that we have a financial product which actually gives access to feed and fodder and to markets like veterinary services, but the challenge is that there are actually very less feed and fodder markets, and actually there are very less service providers, and we need financial providers and fintech companies and private sectors to actually invest in them and see this as an opportunity so that we can actually not only scale but also provide market delivery services to these pastoral areas. So, of course, the livestock insurance program was started with a reason, but of course, as we have to remain relevant and we also have to speak to the demand, we also need to innovate. So as part of that, what we are doing is that we are working with the BOMA graduation program because as if you are aware of the BOMA graduation program, it basically provides loans for women to actually graduate into their business. But the reality also is that when these kind of shocks come, and these protracted shocks, in one go, all the savings and all the business that has been built up can be wiped off. So what we are actually asking that can livestock insurance as an asset protection can actually help the women maintain their resources, and can this work? In the interest of time, I will not go into the results, but what we can say is that we did an experiment, and when we actually coined it in terms of like a household insurance program, we saw that the impact that it had on the uptake with women was incredible, and this we have done in collaboration with the Takaful Insurance of Africa as well as UC Davis UC Davis with the MMR lab. In all of this, none of this would have been possible if we hadn't started innovating around digitization, because one of the facts of the pastoral areas remains that it is very vast and it is next to impossible to go to people on a one-on-one basis. Hence, we also decided to come up with the product that we did. Therefore, like innovating on the digital area was like our priority right from the word go. In some sense, we could say that we actually did some of the things when digital innovations was not even such a craze as it is now. So we basically did work around M-learning, e-learning for the agents so that they can use this as job aids. At the same time, we also working with the insurance companies, we also actually came up with sales platforms. And we also wanted to break the myth that the pastoralists are not tech savvy. Neither is like they can't use smartphones, so we actually use them to collect data for us on markets and rangelands and household nutrition, basically to do ground truthing for the satellite data that we collect as part of our product. So one such example is basically a homegrown platform which is called as Kaznet. The reason why I'm mentioning this is tomorrow there is a whole session on this. So I would really urge all of you to go there. And so basically using crowdsourcing techniques and using the pastoral members of the pastoral community, we actually collect data on markets and on rangeland conditions as well as nutrition. And one of the reasons why we started doing this was that we realized that, going back to the previous point that I made, that there is number one, no information on how the market works. And secondly, in terms of where should people be going, like, in case we want to even know and understand the ground conditions. So far, we are working in about 31 markets, and we are actually working through 200 livestock producer groups. And the idea is that not just to work in terms of ground truthing for the livestock insurance work we do, but also in terms of build up a thriving market system, attract more private sector investment, and also also work as a means of anticipatory action and early warning by actually giving this information out there to the pastoral community and see how they actually use this in their decision support tools. So, having given a few snapshots of what we do, so I would actually have my last two slides first in terms of thinking about some food for thought. The biggest one being is that livestock systems are a very central and integral part of the future of the drylands in east of Africa. The main areas of expenditure, and this is something that will resonate with everybody in this room because this has been spoken about since morning, is on consumables like food, firewood, schools, then ceremonies, emergencies, inputs during dry seasons, livestock medicines, and veterinary services. One thing to note is that, like, contrary to popular belief, the pastoral community and the traders over there are extremely entrepreneurial. It's just that they don't get the chance to show their entrepreneurship, but they thrive, right? They've been thriving for more than 1,000 years, and there must be a reason why they do that, and they do it so well. So therefore, designing financial services should speak to the context and the environmental of the drylands, and that's why it requires provision of complementary services and linking things to the broader livestock value chain. Hence, I asked some questions in the morning in terms of where do the fintech companies and where do the banks see themselves contributing to the livestock sector in a more productive and a more proactive way. And secondly, the acknowledgement that sometimes the barriers just do not exist from the demand side, they might actually exist from the supply side. We have had first-hand experience where private sectors start cringing the moment they talk about things like awareness creation and market development, but the fact of the matter is that we need everybody to come together if you really have to reach the last mile. And if you want the animals, that's where they are. If you want the business, that's where it is. So therefore, and of course, I usually give this example of a car, and where any kind of innovation or any kind of tech or any kind of service is like a car. You might have the biggest horsepower in a car, but if all those elements of research, finance, enterprise, as well as policy and capacity don't go together, which are the four wheels of the car will be a sitting duck. So basically, because at the end of it, if all of this come together, the broader goal at the end of it is about achieving food security, inclusivity, and reduce poverty and increasing resilience. Finally, I leave this presentation with a few areas of thoughts in terms of investments, and this I think is something. It's not research, it's not capacity, but it is about markets, development of the market systems, and attracting financial investment. So therefore, strengthening institutional mechanisms. One of the things that I did not hear in the morning is about increasing capacity and also building capacity, and this works both ways. It's just not about the building capacity of the service providers, but it's also building capacity of the private sector, and which we've learned this in our course of our journey. And then investing in innovative, digitally enabled decision support tools. We've heard a bit about credit scoring. What I would say is a lot of innovation is required in the field of credit scoring, especially if you are to tap this market, which is really untapped but has a lot of opportunity. And finally, I would say that in terms of better understanding gender and youth and inclusion, and we should actually work on systems that are already there to strengthen them rather than eroding them with the kind of interventions we choose to make. And of course, the policy and the institutional infrastructure. What I would say is that the government and the private sector really need to work hand in hand. You cannot say that, okay, we will wait for the government to do something, and the government say that we will wait for the private sector to do something. It's kind of like a nudge and pull relationship. We have to work together. And this I say from experience as Ilri, who has been in this field of working with the private sector and the government together from the last 15 years for the work that we are doing around livestock insurance. Thank you.
Thank you very much, Dr. Rupsha. Yes, you've taken a good amount of time to explain to us some of the key takeaways from your innovative work, particularly around livestock insurance. It's very interesting for me to hear that ILRI has been working on this since 2008, or thinking about it, and looking at the levels you've reached. Very interesting, with 75,000 partners, 43% women. Any major comment, one comment or two comment or question to Rupsha? Yes, please.
Hi, my name is Sharon Kinyanjui. I'm with Everest Enterprises Limited. We work with smallholder farmers across Kenya and basically give them international market access for their horticultural products. Thank you. I know it was a whirlwind, Rupsha, and I was really also looking forward to the second part, which was, I think, more on crops. My question, or maybe my comment, is how do we make sure that we don't have silos of either products or research? Because what you're doing in the in the livestock space is fantastic. I'm sure maybe you've created something similar in the crop space. How do we then make sure that each different organization is not creating its own research base of really valuable information, but make it accessible to all and different stakeholders? Thank you.
Very interesting question. Any other? One more? Okay.
My name is Kevin. So I'm interested, these livestock, when they're insured, does it have to be a large quantitative amount of livestock, or when it comes to even the rural area setup whereby a grandmother could be having like 5, is that also tailored for insurance? Thank you.
Okay, so thanks for the questions. I'll take the first one. So yeah, so how do we prevent that there are no silos? So so I represent the International Livestock Research Institute, which is part of a bigger 15-centered group of the one CGIR. It was initially called as a Global Center for International Agriculture Research, but we keep changing our acronyms like everybody does. So we are basically a group of 15 research institutes, each with their own specialty. So for crops, so we focus mainly on livestock and more of the mixed systems. So, but for crops, and there is actually a lot of work going on, and I think there are some partners here in this room who have been working with the likes of the Alliance of Biodiversity and CIAT, or even ICRAF. So these are the groups of people, our IITA, who have been focusing a lot on crops and on crop innovation. And actually there is some work in partnership with us which is going on under one of our initiatives on livestock and climate on credit scoring for smallholder farmers, which we now want to see how we can sort of innovate and customize for the drylands and the pastoral areas. So I think but one of the things that we as CG centers are not really good at is chasing after private sector. So we would urge that you come to us. It just makes our lives easier, but we are very eager and very keen to work with you. Yeah, so I think that is what I would say. And for more, if you want any contacts or anybody, though I don't see anybody from the Alliance in this room, but I know there are a couple of them in the event, so please go and reach out to them. For the second one, in terms of the quantity of livestock, no, there is actually no quantity as such, as in like that's how we also in some way get the trust and the confidence of the community, because sometimes it happens, and in the beginning it used to happen that somebody used to come and just insure one goat or one sheep. But we let them do that because that's the whole point. As in, like, if they feel that that is something that that helps them, like get with the payout, helps them to give them some of the household items which they actually can use as pocket change, as we call it, like say to pay off school fees or to pay off credit, so be it. So it's not a conditional payout, as in like besides making soap or maybe buying guns, like, you know, or getting married off somewhere, if they're like using it for something useful in their household, it is something that is allowed. Yeah, thank you.
Yeah, thank you very much, Dr. Rupsha. Just a hand of applause for her. Yeah, just some few takeaways from myself in terms of from these sessions. One, to say, yes, this is the AgriFin learning event, 7th learning event. The theme is around collaboration, and one of the interventions of AgriFin is actually to broker these partnerships. It's very interesting to hear from ILRI in terms of what and digitization initiatives, including BOMA graduation and CalNet, and speaking about the design questions that are spoken a lot, especially when looking at crop insurance or smallholder farmers from a crop perspective. So this has been very interesting to see even the progress that is being made within the IGAD region, looking at the work you've spoken about in Kenya, Ethiopia, and some of the work in Somalia and Sudan. I think from the first session that we had, where Pharaoh Cheng from FSD painted the picture for us in a situational analysis, it was keen to see that talking about 50% post-harvest loss for smallholder farmers. 94% of those smallholder farmers saying that storage is at home. And so it was interesting, the panel that you moderated here in terms of the movement towards warehouse receipt financing, from the conversations with the Warehouse Receipt Council, Agriculture Finance Corporation, and also the insights from Genesis. So for me, it was interesting to hear from the council key point around the cost, the high cost of collateral management as a critical barrier towards especially enabling systems that bring on board smallholder farmers. So it's, we'll be seeing how that goes in terms of the interventions with the millers that Jacqueline Odundo spoke about. It's interesting to hear, even as thinking about from a commercial bank perspective, we had banks coming up later, but what's the cost of collateral management? Does it serve beyond the corporate that works with collateral managers that you mentioned? For example, in Kenya, there are 5. In Uganda, we have 2 active ones, 1 major player. SMEs being charged about $2,000 to manage, per month to manage a warehouse that is collateralized. That's on a private sector system, although the government there is also working on the warehouse receipt system. But the thing is, to me, is what's the role of private sector, particularly private collateral management, and is there a role for SMEs or aggregated smallholders through the channels that were spoken about here, whether it's farmer cooperatives? So we'll be keen to see how that goes on, all the best with the various initiatives that are taking place. Key insight, I think the question from Tito was, will the financial institutions, do they have the confidence in these warehouse receipts? Do they have the confidence, whether it's government-led or private sector, to be good to see how that goes? I think from the next session, the one that Jamie moderated with the commercial banks, we had Family Bank, we had NCBA Loop, we had Equity Bank. Very interesting experiences around the challenges that they have faced with partnerships. The theme of the ALE this time is collaboration. How can we build collaborations? So the challenges around those partnerships were very interesting. Thank you very much to the panelists for sharing quite a bit in terms of your personal experiences as institutions or as individuals, looking at changing policy that affected NCBA or Loop TFS in Tanzania, looking at the trust issues that Equity Bank spoke about, questions of data sharing, and importantly, I think from Family Bank, he emphasized one of the issues that was brought about by FSD in terms of alignment of expectations. When we're defining these partnerships, because that actually does affect the life and the health of those partnerships and how well you can go, even whether you'll be able to learn much together if your expectations, if your incentives are not aligned. So very important conversation there. Interesting to hear that all of you are looking at partnerships, especially the banks that were here. Mentioned a few things in terms of scale, de-risking opportunities. Perhaps that's a role of the development sector as well and government in terms of providing risk-sharing instruments, credit guarantee facilities. We are beginning to see even private agtechs already looking at whether those instruments will be useful for them as they scale their solutions. So a lot to learn in the industry. The questions of the commercials and revenue sharing. I think there was a nuance that was brought about here by Equity Bank. Beyond revenue share, there's also the question of, are some of the partners willing to just pay for the service? So if you're a fintech or agtech, can you provide a service to these financial service providers and charge it as a service if the conversation around revenue share is where the bottleneck is? So keen to see how these partnerships develop. AgriFin does support some of these initiatives, like the part of the work we're doing across the region. Yeah, so, and the questions of convergence of data, I think it's important, the last point that was brought about in terms of, from a partnership perspective, the call from one of the banks was that, is there a role for a data hub? Converge data, who is going to play this role? We recently had a workshop with the financial sector, Deepening Trust of Uganda, and working with the Bank of Uganda in terms of, so what's the role of convergence and aggregated data? Who is going to lead? Is it the public sector? Is it the private sector? Can the private sector trust themselves to lead that conversation around convergence? Obviously, there's a role of public sector on data sharing, data integrity, the roles and the rules around even GDPR, and the respective data sharing policies and acts and legislations that are in the region, which some of them are pointing towards GDPR. So it would be good to see how these partnerships as they develop and whether there is a role for data as a public good and what role the partnerships and effective partnerships will play, whether with the private sector, with the public sector, inclusion of the development sector, and how that helps build our collaborations better. So we want to appreciate your time in sitting through these presentations. We've shortened it a bit because of the time we lost in the morning. And we want to welcome you for lunch. There will be lunch, I think, served closer to the pool. Nyama Choma Ranch. Take the opportunity to continue to build potential collaborations and partnerships as we wait for the afternoon session, which I believe starts at 2:15 at Jumbo, the main room where we started in the morning. It's called Jumbo for those who did not make it. So enjoy your lunch, ladies and gentlemen.